Okay, I'm reading the Community Reinvestment Act. It was enacted in 1977 to encourage financial institutions to meet the credit needs of the communities where they are chartered. Regulatory agencies rate each bank's performance in assessing and meeting these credit needs. Banks receive a CRA rating separate from safety and soundness or regulatory compliance ratings. The CRA has gone through many changes since 1977. Public awareness of CRA has grown steadily since 1980, and community groups have used this law successfully to encourage banks to provide grants and special loan programs at favorable rates. In August of 1989, as a result of the need to reform parts of the law, Congress amended CRA to require that an institution's CRA rating and evaluation be made public. In 1990, the FFIEC issued detailed guidance on the 5 assessment categories considered when a bank is examined for compliance with CRA. Nonetheless, bankers and community groups still regard the CRA regulations as focused too much on process and not enough on performance. In 1993, the federal agencies began a major overhaul of the CRA evaluation process that was completed in early 1995. The revised regulation adopted a tiered examination structure, with smaller banks eligible for a streamlined examination, separate criteria for wholesale banks and limited purpose banks, and a 3-part evaluation process for larger banks: the lending test, the investment test, and the service test. Finally, any institution may choose to be examined under a strategic plan. The next major change for CRA occurred in 1999 with the Gramm-Leach-Bliley Act. Congress changed the statute so that examinations for small banks with outstanding CRA ratings are conducted once every 5 years, with a small bank, while a small bank with a satisfactory rating is to receive a CRA examination no more frequently than once every 4 years. In 2005, the federal agencies jointly agreed to change the definition of large bank, and all of the agencies, with the exception of the OTS, added the category termed intermediate small banks. These changes were in part designed to ease some of the burden on smaller institutions by eliminating data collection requirements. The changes also increase the options for community development, lending, and investing by allowing institutions to count activities that benefit federally designated disaster areas and distressed or underserved rural areas. In 2007, the OTS modified its regulation to conform to the other agencies' rules on performance, using the same criteria for other small banks, but are also rated on their community development performance. In 2011, the OTS was merged and its regulations were transferred to the OCC. One of the most important elements of the CRA evaluation process is the tiered system. Under this tiered system, banks not evaluated under the wholesale, limited purpose, or strategic plan are separated by size. The base levels, effective January 1, 2012, for determining into which category a bank falls are based on asset size, with a small bank being any bank with less than $1.160 billion in assets on December 31st of either of the last 2 years, while a large bank is an institution with $1.160 billion, which was added in 2005. Created intermediate small banks, institutions with at least $290 million in assets on December 31st in both of the 2 prior years, but less than $1.16 billion on December 31st of either of the 2 previous years. These thresholds were adjusted annually based on changes to the CPI for urban wage earners and clerical workers. Coverage. CRA covers all FDIC-insured financial institutions. It does not apply to special purpose banks that do not perform commercial or retail banking services by granting credit to the public in the ordinary course of business, other than as incident to their specialized operations, including banks that engage only in one or more of the following: cash management, controlled disbursement services, correspondent services, trust companies, and or clearing agents. So I'm still on, well, that does it for the coverage section. On the requirements section of CRA, the delineation of assessment areas is Part A. Banks must delineate one or more assessment areas within which the regulatory agency will evaluate the bank's record of helping to meet credit needs. The assessment area must consist of one or more metropolitan statistical areas. MSAs. MDs, metropolitan divisions, or one or more contiguous political subdivisions, counties, cities, or towns, and include the geographies in which the bank has its main office, branches, and deposit-taking ATMs, as well as surrounding areas where the bank has originated a substantial portion of its loans. Wholesale or limited-purpose banks must designate as an assessment area one or more MSAs or metropolitan divisions, or one or more contiguous political subdivisions such as counties, cities, or towns in which the bank has a main office, branches, or ATMs. Banks must adjust assessment areas to include only the part of the political subdivision that it can reasonably expect to serve. Banks' assessment areas are limited as follows. Must consist only of whole geographies, census tracts, may not reflect the legal discrimination, may not arbitrarily exclude low or moderate income geographies taking the bank's size and condition into account, and may not extend substantially beyond the MSA boundary or state boundary unless the bank serves a geographic area that extends substantially beyond a state boundary. Generally, assessment areas must be designed for each state the bank serves, and separate assessment areas delineated for areas within the MSA and outside an MSA. Banks whose business is predominantly serving the needs of military personnel who are not located in a defined geographic area may delineate its deposit customer base as its assessment area. Required collection of data. Banks other than small banks, for example large banks, must collect and maintain data on small business and small farm loans originated or purchased. This information must be maintained in machine-readable form until the completion of the bank's next CRA exam, and must be reported with its Home Mortgage Disclosure Act loan application register by March 1st of the next calendar year. Definitions. A small bank is a bank that, as of December 31st of either the prior 2 calendar years, had assets of less than $1.16 billion. An intermediate small bank is a small bank that, as of December 31st of both of the prior 2 calendar years, had assets of at least $290 million, but less than $1.16 billion as of December 31st of either of the prior 2 calendar years. And C, a large bank is a bank that, as of December 31 of both of the prior 2 calendar years, has total assets of $1.16 billion or more. 2. Small business loans are loans included in the loans to small businesses category on the bank's consolidated report of condition and income. Small farm loans are loans included in the loans to small farm category on the bank's consolidated report of condition and income. Data to be collected includes a unique number, that got smaller. A unique number, or alphanumeric symbol to identify the loan file, the loan amount at origination, report the entire amount of the line of credit, the loan location, physical address of the business or physical address of where the loan proceeds were used, and an indicator whether the loan was to a business or farm with gross annual revenues of $1 million or less. Loan renewals also must be reported. Renewals should be reported only once a year unless new funds are advanced. Optional data collection. Consumer loans. Banks may collect and maintain data on consumer loans originated or purchased by the bank in machine-readable format. For